How's it going, everyone? And welcome to a special solo series of Wealth Strategy Secrets of the Ultra Wealthy. I'm your host, Dave Wolcott. We get a lot of the same questions from our investors about infinite banking, tax efficiency, asset protection, strategy stacking, and how to actually build wealth outside of Wall Street. And we get it. We know you're busy. So in this series, I'm breaking down complex wealth strategy topics into short, tactical episodes that you can actually use to build legacy wealth. Whether you're just starting your journey or fine-tuning your portfolio, these episodes are designed to give you high-impact insights in just a few minutes. So let's dive in. When we talk about investing in private markets, whether that's commercial real estate, energy, private credit, or another sector, it's important to understand that not all sponsors are created equal. The market is segmented into distinct tiers, and where you choose to invest directly impacts both your potential returns and your risk profile. I like to think of this landscape as a pyramid with three main tiers of sponsors. The bottom one being tier one, where you have emerging sponsors. These are smaller sponsors, often entrepreneurial in nature. They also typically have about less than 200 million in assets under management, which means that their balance sheets are thinner and their operating scale is actually quite limited. There's also many who are talented, but yet haven't built a full track record across multiple economic cycles. So they've only probably gone full cycle, maybe with one deal, two deals, or three, just only a few. They're also receiving their capital directly from retail investors and rarely from institutional capital. This includes friends, family, or small pools of high net worth individuals. Now, what's interesting in terms of an opportunity perspective is because they're competing for attention, these smaller sponsors may put forward much more compelling return profiles in their investment pro formas with higher IRRs, higher preferred returns, or equity multiples that may be enticing. However, keep in mind that there are some risks in investing with these sponsors because the execution risk is higher. They may lack the systems, the team depth, or actually capital reserves to weather downturns. So understand that if you invest with this tier of sponsors, you're definitely taking on a risk premium in exchange for those higher projected returns. Now, the second tier is really what I would call a mid-market sponsor. And this is typically where sponsors are actually attracting capital from family offices, ultra high net worth individuals, also RIA capital, such as independent investment advisors that can invest in these private assets. And this is, I think, where the sweet spot really may lie for many sophisticated investors, because these sponsors have crossed an important threshold. They've actually built a proven track record with multiple deals. They've seen multiple cycles, and they typically may have over $1 billion or several billion in cumulative transaction volume, which means that they have a great track record. They also have teams that are very experienced, that have gone through different economic cycles and really understand how to anticipate, how to be resilient in changing economic cycles, and really operate with institutional quality processes. I would also say that they go through an extensive amount of diligence in terms of putting their deals together. Also, you'll have capital sources here that would include family offices, again, independent IRAs, private wealth channels, things such as that. The due diligence bar here is much higher. So to access these types of opportunities, when a family office or an RIA is actually placing capital, they go through much more rigorous standards because of the compliance through SEC and such, to be able to go through that underwriting and diligence process. So when you know that you're investing alongside of these other institutions, you know there's a much greater degree of operational excellence here. you often get strong risk-adjusted returns, which means that you might have a slightly lower projection than in the first tier we talked about earlier, but you also have increased predictability and downside protection in this tier. Maybe some of the risks might include that with these stable and more, secure and experienced sponsors, that they don't deliver a home run on your opportunity with, much larger, say, multiples or deal terms. However, the returns do reflect a much more of a balanced trade-off where you have a moderate yield with lower tail risk on that. Now, the third tier would be institutional sponsors, and this is where we see large institutional players at the top of the pyramid. These are global firms with tens of billions in assets under management who manage capital for pension funds, insurance companies, endowments, and they generally don't work with retail investors. Access is usually through institutional allocations or in some cases what they call feeder funds. The opportunities with these sponsors often bring unparalleled experience, scale, and resources, and the perceived safety is much higher, knowing that your capital is aligned with some of the world's most sophisticated investors. Some of the risks, however, or downsides in investing in this tier of sponsors is that the returns are generally more compressed. You may see, let's say, a 9 to 12% type return. And for a pension fund, that's absolutely huge. If they can drive the predictability to that, they'll go for that type of return, or, let's say a 14 to 16% IRR. They'll take that all day long. And why? Well, because pension funds and these institutional players are really looking for that stability and long-term predictability versus outsized IRRs. Retail investors often can't access these groups directly, and if they can, they may be paying for additional layers of fees. So in closing, when evaluating private investments, you really need to ask yourself, do I want higher projected returns but higher execution risk of an emerging sponsor? Or do I prefer the balanced risk-adjusted returns from mid-market sponsors vetted by other family offices? Or am I looking for the stability and institutional safety, even if that comes with lower returns, but you're working with some of the largest global firms out there? Each tier really has its place in a well-constructed portfolio, and the key is just understanding that higher returns on paper usually come with higher risk, and that the sweet spot for many private investors tends to be tier 2, where you can achieve attractive returns with institutional quality execution without sacrificing all the upside to compressed yields. Thanks for tuning in to our special solo series. If this episode sparked something for you and you're ready to learn more, head over to holisticwealthstrategy.com and download a free copy of my book. You'll also get access to our investor community where we share exclusive educational content, new opportunities, and resources designed to help you accelerate your path to freedom. And if you want to take it even further, book a call with our team to learn about our virtual family office services or join our mastermind group where we go deep into building true generational wealth. I'll see you on the next episode.